And welcome to this Gravita webinar, the latest in a series of webinars that Gravita have been doing. Today we're going to look at sort of some tax planning ideas that you can think about pre-6th of April. The end of the tax year is not far away, and there's some very straightforward things that you can think about. And we're going to talk about things like making use of pensions and maximising your tax reliefs for those, donations to charity, using gift aid, ISAs, saving tax effectively in tax sheltered accounts. Looking at dividends and dividend extraction, it's not quite the obvious choice it once was, given that the increase in the dividend tax rates. Capital gains tax, we'll have a look at that, and making tax digital. A lot of you are Gravita clients. For those that aren't, let me tell you a brief bit about Gravita. We're a mid-tier firm. We've got technology at our core, and we utilize technology with our clients for efficiency, and it certainly helps in tax planning as well, and our clients like it. So for any of those that are not Gravita clients that want to talk about how we can assist you in an AI tech world that we live in, do let us know. Reach out to any one of us and we'll be very happy to help. Today I'm joined by two private client directors at Gravita, Charlene and Lekhrani, and they are going to take us through those topics that I mentioned earlier. And Lekhrani is going to kick off with pensions. Now, Lekhrani, are pensions still the sort of tax efficient way of saving for future?
Thank you, Dion. Obviously, this is pension contributions. They do still remain a very tax efficient way to save towards your retirement, especially given the fiscal drag that we are in, with the freezing of the personal allowances and the tax thresholds, coupled with the increase in the tax rates. We are certainly paying more to the taxman every year than before. So if you're thinking of topping up your retirement pot, 5th of April 26 is certainly the deadline to do so by. So what's the tax reliefs? Relief on pension contributions, that's available to UK resident taxpayers up to 100% of their relevant earnings. Relevant earnings, you may ask what they are. So relevant earnings are nothing but your employment income, trading income, your partnership income, but not your investment income or your capital gains. And if you're thinking that the relief on 100% of your relevant earnings is too good to be true, then you're absolutely right. Because what HMRC has recently introduced is an annual allowance. The annual allowance is basically the limit of how much you can contribute across your pension pots while still benefiting from the tax relief. This limit has unfortunately remained unchanged since 2023-24, and it currently stands at 60,000. It's worth noting that the annual allowance is inclusive of the tax reliefs on pension contributions, and it also includes for employees the employer share of the contributions that they are making on your behalf. Like every allowance that we get given by HMRC, there are always restrictions. And in that case, the restrictions for your annual allowance, they are based on your adjusted income and your threshold income. That calculation is somewhat complex. So if you need any help on doing that, please do let us know. But in any case, if your income is above 360,000, that's your adjusted income, the minimum allowance that you will receive is £10,000. So how does your annual allowance affect us? If your pension contributions in a tax year exceeds your annual allowance, that excess of pension contribution is subject to an income tax charge at the taxpayer's marginal rate of tax. So if you're a higher rate taxpayer, 45%, that excess pension charge will be taxed at 45%, and this is added to your income tax liability. And in certain cases, taxpayers can also request for that charge to be paid for by their pension provider. However, it's not all doom and gloom for now, as HMRC does allow taxpayers to carry any unused allowances you have for the last 3 tax years in addition to the current year allowance. These are used on a first in, first out basis. So what do we mean by this? For 25-26, that allowance will need to be used in priority before taxpayers can utilize their unused allowance for the last 3 tax years. By 5th of April 26, taxpayers can utilize their allowance for 22-23, 23-24, and 24-25 tax years. But you need to remember that to be able to utilize these unused allowances, you need to be a member of a registered pension scheme at some point in that tax year even if you haven't made any pension contributions. So that's a very important point to note because we do see a lot of clients getting caught out. So how do we claim for these pension contributions? There are two main methods of relief. The first relief, which is basically the default method, is the relief at source. And the next one is net pay arrangements. We'll go through both of them. Under the relief at source method, taxpayers make pension contributions net of basic rate of tax. And it is for the scheme administrator to then reclaim the sum deducted from HMRC. If you're a higher rate taxpayer or an additional rate taxpayer, you can claim a relief on your self-assessment tax return. And this is given by extending your basic rate band and higher rate band by the gross amount of pension contributions. We will look at the numbers in a minute. Whilst on the net pay arrangements, this is basically your salary sacrifice, whereby your employer deducts the pension contributions from your gross pay, thereby reducing the tax and NIC that you're subject to on your income. You may ask if there are any benefits of pension contributions given all these restrictions that we have. There certainly are. So the next slide will give us the table where you could see as a basic rate taxpayer, if you contribute £800 towards your pension pot, what reaches your pension pot is £1,000, and the total tax saving is £200. Whilst if you're a higher rate taxpayer, your contribution will only be £600. Again, what reaches your pension pot is still the £1,000, and the tax saving is £400. Whilst if you are an additional rate taxpayer, we have £550 being contributed. Pension pot still receives the £1,000, and the total tax relief or the tax saving for you will be the £450. So you could see clearly from the table that there are certainly some tax benefits for you for every £1,000 that you save in your pension pot. The other benefits of pension contributions. Tapering is HMRC's favorite tool to reduce any of the allowances or benefits that taxpayers receive. If your total income exceeds the £100,000, your personal allowance is reduced by £1 for every £2 that you earn above £100,000. In order for you to preserve your personal allowance, you could still make that pension contribution. What it will tend to do is reduce your threshold income below £100,000 so that you do not lose your personal allowance entirely. And the effective tax rate on your income, if you lose all your personal allowance, is 60%. So you can do the maths. If you contribute to your pension pot, how much are you giving back to the taxman? Likewise, if you're in receipt of child benefit and your income exceeds £60,000, you will have to pay high income child benefit charge. And this is at 1% of child benefit for every child benefit of £100 you earn above £60,000. Again, with your pension contributions, they help to keep your taxable income below the £60,000 threshold. With the employees who have salary sacrifice in place, as mentioned before, you have your tax and national insurance saving, as these pension contributions are deducted from your gross pay. However, in our recent budget, it was announced that from April 29, there is an annual limit of £2,000 for pension contributions made via salary sacrifice, and that's the limit that will benefit from NIC exemption. You could still contribute towards your pension pot through salary sacrifice, but the limit that will qualify for an NIC exemption is just for £2,000. So that's one more reason for you to maximize the pension contributions. And as we all know, our pension pot, it grows tax-free, free from income tax, free from capital gains tax. And when you come to withdraw your pension, 25% can be withdrawn tax-free, and the rest will be taxed as income. So that's a little snippet on how you can use your pension as a planning tool.
Yeah, thanks, Lekhrani. And I think it's the important takeaway there is from a tax perspective, how efficient pensions still are, despite the sort of adjusted income and threshold income thresholds, annual allowance threshold as well. But, you know, that example you gave, an additional rate taxpayer can make £1,000 contribution into their pension scheme by paying at £550. Basic rate payer just at £800. It's incredibly important. But When you talk about net relevant earnings and salary, is there anything beyond salary? Is it just salary that goes into that relevant earnings?
So that's a very good question, Dion. So a lot of the employees that receive salaries, they also receive bonus payments. So what employees tend to do is at the end of the year, they also sacrifice their bonus. So the bonus there is the salary sacrifice that will apply to your bonus, and then that goes straight to your pension pot. Obviously, you have to bear in mind of your annual allowance there. And in some cases, if you do not have any relevant earnings, you can still contribute towards your pension pot. So HMRC has that limit of 2,880 that you can pay into your contribution, into your pension pot, and this is grossed up by your basic rate and then it goes, what reaches your pension pot is the £3,600.
Yeah, and I like that point, especially about if you're getting a bonus or have got a bonus and you want to know how to make it more tax efficient, the use of a pension is certainly something to consider. And we can help you with that. So if you're in that position, do let us know, and we can certainly help with that. We've read a lot about pensions coming, or will be coming into the scope of inheritance tax, and that's been subject to other webinars in the Gravita series. But if any of you want to talk, any of your usual Gravita contacts or any of us, if you're not a Gravita client, about that, and it's inheritance tax planning around your pension pot, then do reach out to us and we'll be very, very happy to help. So pensions is one thing. It's still a good tax efficient way of saving for your future. If you did have excess income and you wanted to make charitable contributions, there are some things to think about, and they're still tax relieved and tax favoured as well. And Charlene is going to run us through gift aid and charitable giving. Charlene.
Yes, thank you, Dion. So first of all, when we look at gift aid and charitable giving, we have to think about what's included. So normally we look at donations to registered UK charities. Normally there'll be a charity number, and often when you're making a donation, you'll be asked if you want to gift aid that donation to get the tax relief for the charity and for yourself. You can gift shares or securities to charity or land or buildings. You can give via payroll, and then you'll have the relief at source via PAYE. Donations to community amateur sports clubs are included, but not subscriptions. And you can also include payments to religious institutions. So if you're making regular payments to your church, your synagogue, your mosque, these could also be gift aid relevant. So if we run through an example of how this works. So we'll take the simple example of a self-employed individual. So because they're self-employed, we're just looking at them receiving their income gross with no tax deducted. Obviously, if you've got different income at different rates, such as dividends, they'd be subject to higher rates. You may also have other income, other reliefs, credits, losses interacting on your tax return calculation. But for now, we're just going to look at self-employment income of £100,000. So at £100,000, you're still going to have your personal allowance of £12,570, which reduces the taxable income down to £87,430. So the basic rate threshold is £37,700, and that's taxed at 20%. And then the balance is taxed at the higher rate of 40% because we haven't crossed the additional rate threshold. So in this example, this individual, not including national insurance, has got a tax liability of £27,432. So if we look at them making donations of £8,000, these can be regular donations or a one-off donation. As long as this is relevant for gift aid, then that donation of £8,000 will be grossed up to £10,000. So you may notice when you make a gift aid declaration, it will state that 25p will be given for each pound. And so that's factored into this calculation. So the self-employment remains at £100,000, the personal allowance, and then the taxable income is still £87,430. But when we include the gift aid, the basic rate threshold will be £47,700 rather than the earlier £37,700, and the balance being taxed at the higher rate of 40%. So for this example, a donation of £8,000 grossed up to £10,000 gives you a £2,000 tax saving because we've increased the basic rate threshold. It's a good point to note that there's no limit on the donations that you can make. So it's really useful if you're going into the additional rate or you've got substantial capital gains tax to pay.
That's really important, isn't it? I think you can sort of make a £10,000 donation to charity by giving them £8,000, and then the charity claims the 2,000 back from from HMRC, and you get the higher rate taxpayer gets 20% relief in their tax com. It's really useful, and it's a nice way of giving and giving tax relief as well. Charity gets more, and you get some tax relief on it. But is there anything that we should be looking out for?
Yes, absolutely. So not all donations are going to be eligible. As I said, you can have one-off donations or regular donations, but they need to be to a registered UK charity, which, as I said, can include religious institutions. But you may need to exclude donations made to crowdfunding or GoFundMe, for example. So the next point to look out for is record keeping. You should keep your gift aid declarations because HMRC may require sight of these if they look into your return. The dates to include are important as well. You can include donations made within the tax year and also up to the point that you file your return. So, for example, when the tax year ends at the 5th of April, if you're not preparing your return until January, then you can include the donations made up until that date. Again, record keeping is going to be really important here to make sure that you're not omitting or duplicating any donations. Next point, not all donations. So if you're receiving anything other than a warm and fuzzy feeling inside, then this may not be relevant for gift aid. You shouldn't have an entry into a raffle, for example, or be paying for a gala table. They're still relevant donations, but they may not be eligible for gift aid. And lastly, it's important that you have a tax liability. So when you make the gift aid donation, you declare that you're a UK taxpayer and that you have a tax liability. If you don't have a tax liability, then making the gift aid donation could create a tax liability. So if we think about the earlier example where we reduced the tax bill by £2,000, if there had been no tax liability in that instance, there would be a tax bill of £2,000 that would need to be paid as a result of making that donation of £8,000.
Yeah, it's an important point, isn't it? It's, when we said earlier about the charity claiming the 20% relief from HMRC, they will do that and HMRC will pay it. And if you've paid enough tax, that features in your tax calculation. If you haven't, HMRC will come after you for that tax. So It's not actually HMRC giving them the money, it's sort of them facilitating the repayment. So I think that's a hugely important point that you raised. Additionally, that sort of not all donations are eligible is important as well. If you're getting value for the money you're giving, that won't qualify for gift aid. And as a tax investigation specialist as well, if you don't keep records, you do make a rod for your own back. So there's still a very good way to give to charity tax efficiently for the charity and for yourself as well. So you do need to watch out for those traps as you mentioned though. Thank you. And after you've made your charitable donations and you've got that warm and fuzzy feeling, attention might turn to yourself about how can I save, how can I provide for myself in the same tax year. And individual savings accounts are certainly one for those. And Lekhrani, you're going to talk to us about ISAs.
Indeed, thank you, Dion. So ISAs, they have been around for quite a while. And from an income tax perspective, ISAs do still remain an accessible, tax-efficient planning tool available to UK tax residents. The investment in the ISA account, they grow tax-free, free from income tax on the returns. So the returns will be your dividend income, if that will be your interest, but it's not subject to income tax. And no capital gains tax on the growth and ultimate disposals of these investments. Given their exempt nature, these income and gains from the investments, they are not reportable to HMRC. So all in all, very good. So what's the allowances for 25-26? We have up to 20,000 a year, which we can save into a combination of the following different types of ISA. We have the cash ISA, which basically relates to your savings in your bank and building society accounts. These can also include some of the NSNI product as well. You have your stocks and shares in an ISA account. So again, that's just your shares, stocks, and it can also include government bonds as well. You have your lifetime ISAs, which can include either stocks and shares or cash. Just bear in mind that here you've got an either or, so you can't have a combination of both cash and stocks and shares. So it's either, stocks or cash. And finally, you have your innovative finance ISA. These relate to your peer-to-peer loans that are given to other people or businesses without using a bank. In addition to the above, we also have a junior ISA for under 18s with an annual allowance of 9,000. The child only gets control of that ISA account at the age of 18. This limit is in addition to the 20,000 limit mentioned above. We've also got age restrictions where anyone aged above 18, except for the junior ISA, can open an ISA account, although the lifetime ISA, you have to be under 40. HMRC has made contribution to an ISA a bit more flexible, as from 6th of April 24, an individual may only subscribe into one of each time of, before the individual could subscribe to only one type of ISA. However, from 6th of April 24, this has been removed and cash ISAs can be transferred to stock and shares ISAs and vice versa without affecting the annual limit. But that was too good to be true again, because following the recent announcement in the autumn budget from April 27, the cash ISA limit has been reduced from 20,000 to 12,000. Unless you are 65 years old, when the 20,000 limit, that will still remain. To be able to save up to the 20,000 limit, a saver will therefore have to invest the remaining £8,000 into a stock and shares ISA.
Yeah, there's certainly some tax planning to be done around ISAs. I was looking at some statistics, and apparently if you'd saved the maximum you can in ISAs from the start, you'd be an ISA millionaire by now. Apparently there's over 5,000 ISA millionaires, so £1 million in a tax-efficient, tax-free fund is remarkable. That same sort of statistic, apparently 873 billion is held within adult ISAs, 360 billion of which is cash and 512 billion in stocks and shares. So there is a lot of money that is avoiding tax in ISAs. They're easily forgotten and shouldn't be, because they are remarkably good, safe tax planning tools. They are going to be brought into the scope, or they are within the scope of inheritance tax. So when we say tax-free, that's income tax and capital gains tax-free. They're not free of inheritance tax. So if you are one of those ISA millionaires and you'd like some tax planning about how to avoid a 40% inheritance tax charge on it, do let us know, and we can factor that in as part of a wider inheritance tax planning for you.
And we've also have additional tax planning that we can use with ISAs, as highlighted before. The investment in the ISA, it grows tax-free. When you sell it, it is capital gains tax-free. Taxpayers can also sell the investments they have in an ISA account and acquire these investments for an ISA account, just to shelter the future gains and returns from any tax. And for married couples, each spouse receives an allowance of 20,000, so about 40,000 that you have in a household. Unlike the allowance for pensions, whereby the unused allowances are carried forward to be utilized, the ISA allowances are not, if you're not used, then these are lost. And it's also worth noting that if you're leaving the UK, you can still have your ISA account, but that tax-free investment income and growth does no longer apply. So it is important for you to do proper tax planning when it comes to your ISA account.
Yeah, I think that's an important point to note, isn't it, Lekhrani, that the relief is use it or lose it. Unlike pensions and gift aid, you can't make out of year contributions and get tax relief on it. So if you get past the 5th of April and you haven't used your ISA allowance, it will disappear. Yeah, there's no claim you can make to restore it. So do watch out for that. But look, aim to be one of those ISA millionaires, and you'll have an account with £1 million in it that's not paying any tax.
It's also worth noting that if you're not just saving for yourself, saving for your children, that the tax benefits there as well. Yeah, I think
that's right. I think there's about 12.5 billion in junior ISAs as well. So there's a lot of people saving for their kids. The child can access the funds at 18. So it's a bit like a bare trust, if you like. But there's an important point there, isn't there? That with this fund, it doesn't come to within the parental settlements legislation. So if I set up an account for my son and I paid cash into it, the interest that arose on that will be taxable in my hands under the parental settlements. But that's not the case for junior ISAs. So that's a very good point. It can feature in part of your planning as well. So if you've got a company, if you are self-employed through your own company, and you want to know whether to take a salary or take dividends, that isn't as obvious as it once was. But Charlene is going to run us through what changes have happened with dividends, and it might get you thinking about how you extract money out of a family company or not, or leave it in. But Charlene.
Absolutely, yes. So the dividends allowance is now just £5,000 per annum. Again, it's a use it or lose it situation. We've seen this be much higher in recent years, and the tax rates were certainly very favourable for quite a long time. Now we've got the dividend rates have been increasing steadily over the last few years, and they're set to increase again in April 2026. So basic rate dividends are currently taxed at 8.75%. This is going to increase to 10.75% on the 6th of April 2026. Similarly, higher rate dividends will be increasing from 33.75% to 35.75% in April 2026. The additional rate remains at 39.35%. So as Dion was saying, it's not clear cut as it used to be in terms of salary or dividends. It's becoming much more expensive, and there are a lot of different factors to consider, including the costs of incorporating a company and various other things that you might want to think about. So it's something that we need to look at, and we can run the numbers for you if you need us to. Yeah,
and it's certainly sort of individual circumstances. Some may take a salary from the company, some may be employed elsewhere, so they wouldn't take a salary to utilise a personal allowance if they have one. If the salary elsewhere is higher, you wouldn't plan around that. But the question of whether you take salary or dividends used to be relatively clear cut. It's less so now. The dividend rates have gone up. Anything beyond sort of 50,000-ish probably looks like you might be better off taking a salary or a bonus rather than dividends. But it really does depend on your individual circumstances, and you would need some planning to look at all of your personal circumstances, and we can certainly help with that. It's interesting to note that they're the rates for sort of England and Northern Ireland. The Scottish rates haven't changed, but their income tax bands in Scotland are hugely different to England and Northern Ireland. So Scottish taxpayers, again, you'd have to take independent advice, and we can help with that. But it's certainly something to think about. The other thing to think about is whether you take a salary at all or dividends at all. Is it ever a good idea to leave the money in the company? Possibly. You could use it for inheritance tax planning. Gravita have done some webinars within the series about family investment companies and property investment companies, and what you can do around inheritance tax planning with those family investment companies. So it might be better for you to leave the money in that company, and then we can, if your focus is on inheritance tax planning and you're thinking about issuing different share classes for different generations, the main shareholders of the company at the moment can retain the voting rights, and you can give dividend rights or rights to assets on a winding up to different classes of shares. So incredibly important to think about how you can get the most out of your company, if you've got a company or you're going to incorporate into a company. Really important to take advice, because there isn't a one-stop shop. There isn't a one advice fits all for that. It really does depend on your circumstances, and we're very, very happy to help with that. And sort of talking of companies, it might be something you're considering disposing of in your lifetime, whether it's through a sale or liquidation, and that would involve you seriously considering the capital gains tax consequences. And Charlene's going to run us through that.
Yes, we've got a roundup of capital gains tax key facts and action points for you. So at the moment, the main rate of capital gains tax is 18% at basic rate and 24% for higher rate. There's also 32% rate for carried interest, which is a little bit more obscure. The annual exemptions, again, as with dividends, we've reduced massively over the last few years. So it's now £3,000 per annum for individuals and £1,500 for trustees. If you have a gain that you're reporting, then when you're working out your capital gains tax, it's very important to include your expenses, the cost of acquiring your asset, establishing title, any improvements, and also disposal costs, which include things like legal and professional fees. If you're not fortunate enough to make a gain, it's important to still record and report that transaction, because the loss can be utilised and offset against other gains, reducing your tax liability. In the current year, you get preferential treatment, so you can allocate a loss against a gain that's charged at a higher rate. If you're not able to utilise the loss in the current year, you can carry it forward indefinitely. And it will be used then on a first come, first served basis. So business asset disposal relief, previously known as entrepreneurs relief, was 10% for many years. It's subject to quite heavy restrictions and limits, but it has increased to 14% at the moment, and it will increase again to 18% from the 6th of April 2026. So if you're in the process of liquidation and you are looking at making distributions, now is the time. Selling a property that's not your main home, there's a 60-day reporting to pay and file. We've got an article on our website about that, written by yours truly. So if you need any help with that, then please reach out to us. If you're making investments in EIS or SEIS, not only are these investments have got their own tax, what's the word I'm looking
Tax
for?
favoured.
Tax favoured, I would say. But you can also use the investments to defer CGT or exempt it, depending on what kind of investments have been made. If your investments fail and they become of negligible value, so little to no value, then again, we look at claiming that loss. It's important to establish your position early. You should have some kind of correspondence from the liquidators as the process goes on. Once you confirm your status, then you can claim the loss, and it's possible to offset this loss against income, not just against capital gains, which means it could be worth as much as 45% at the additional rate of income tax rather than 24% at the higher rate of capital gains tax. So it's a couple of planning points. That transfers between spouses are tax-free for CGT, and that CGT can be deferred in instances when you're looking at selling your business, using rollover relief, or settling assets into trust using holdover relief.
Yeah, and I think that sort of the holdover relief for settling into trust or settling business assets into something else is a really important one. And trusts, again, can feature in inheritance tax planning and should be considered within inheritance tax planning as well. And if you can get a business into a trust for next generations and hold the gain over, it's really, really valuable. What's really valuable as well is that negligible value claim, where rather than holding on to shares with little or no value or negligible value, you can make a claim to crystallize that loss for capital gains tax purposes. But if they're qualifying shares, so they're EIS shares or they're shares you subscribe for in a qualifying trading company, you can make a share loss relief claim. And that means that you turn that capital loss into an income tax loss, and you can spread that sideways to get income tax relief on your other income. So incredibly valuable relief that. And if you are sitting on shares that you think are of negligible value, then you do reach out to us so we can talk to you about that, because you have to get that right. You have to do the first step before you take the second step, and get the negligible value claim in, and then that opens the door to the share loss relief claim as well. So incredibly important. Just a quick point on the annual exempt for the 1,500 of the trustees. That assumes that settler didn't settle multiple trusts on the same day. Otherwise, that sort of gets reduced. It's not a very generous allowance anyway, but just so you're aware. The 60 days to pay and file, that's always one that can be potentially missed. It's easy to forget, and HMRC will start looking to raise penalties on that. They've taken quite a light touch to date, but that's with the pressure to raise more money. I think the revenue will probably pursue those late penalties more rigorously going forward. So it's certainly something to keep an eye on. It's the way of tax now that we have to sort of file things by certain times, and HMRC are going to be looking at how we file and when we file and what we file for. And obviously, making tax digital is sort of 6 weeks away. And Lekhrani, you're going to talk about making tax digital for us.
Absolutely. Although not a tax planning point, but I thought it would be good to remind people about making tax digital. That's coming around from 6th of April 26. So HMRC has introduced a number of limits when you fall under making tax digital. From 6th of April 26, if your income, rental income or self-employed income and/or is above 50,000, then you have to register for making tax digital. From 6th of April 27, that limit is 30,000, and from 6th of April 28, that limit is 20,000. Quite a few numbers there, but We will keep reminding you, like we've always done with our clients. So from 6th of April 26, other than registering for Making Tax, you have to register for Making Tax Digital before you start filing these returns. So these returns are to be filed every quarter. Although no tax payment is required, no tax adjustments are required every quarter. It's just a summary of your income and expenses that need to be submitted to HMRC. And we have 4 quarterly returns that need submitting and a 5th annual return that will replace our self-assessment return. The final return will include the tax adjustments and all other sources of income you've received during the year. For example, your interest, your dividend income, your capital gains. So just bear in mind that, like Dion mentioned, we've got more filing requirements coming to us from 6th of April 26. And the registration needs to be in place before you start doing that. Do we have exemptions and deferrals? Of course we do. So exemptions, what we have is what HMRC are telling us at the moment is some clients may be exempted because they are not technically savvy. But you have to bear in mind that we had Making Tax Digital for VAT. If your client is filing VAT returns using a software, they can't claim exemption for Making Tax Digital for income tax. So you have to be careful with that. Again, exemptions will also apply for clients who've never received a national insurance number. So that will be your non-residents. If they haven't received an NI number, they've never had one, never worked in the UK before, they will be exempt from filing for being under Making Tax Digital. There is also the deferral. The deferral at the moment, the ones we are looking at, will be for your non-resident landlords. If you're a non-resident receiving rental income, meeting the income threshold, you are deferred. That is deferred until 6th of April 27, when then you will be required to be under Making Tax Digital. However, just watch out for any changes in the meantime, because these rules on Making Tax Digital, they are changing very often. So I mentioned about the quarterly updates and the year-end returns. Making Tax Digital is a soft landing at the moment. So the first year that you are making the quarterly returns, there is no penalty. But from 6th of April 27, we have to be a bit more careful with the deadline, with the correctness of the forms, and make sure that we stick to these deadlines. As a Gravita client, you would have been inundated with all the emails you've been receiving about Making Tax Digitals. We do tend to do it on a very regular basis because obviously this is new to everyone. We're still trying to decide on the software, but we are ready to offer the service to the clients. So if you do have any questions, you do require any assistance on how to file these quarterly returns, please do let us know and we'll be happy to help you with those. So that's Making Tax Digital for us, more work for us at the moment.
I think that's the important point you mentioned there, Lekhrani. I think there is a proposed soft landing for penalties. And is that to allow you time to get into the mindset of Making Tax Digital without being penalised? But I think
absolutely,
even with that soft landing, it's probably important to get into the right mindset and sort of get into the habit of thinking Making Tax Digital, just to show you're aware. I mean, don't wait to get penalised and start thinking about it next year when the penalties will come in for sure. I think Gravita clients are probably, as you say, Lekhrani, probably tired of getting correspondence from us about Making Tax Digital, but it really is important. And as a sort of a firm with tech at its core, we embrace Making Tax Digital. I think it is the future of taxation. All taxation services in the UK are probably going to be digitalised, and this is a huge first step with that. So it really is important to get to grips with it. It's daunting, so there are people that can advise you on that, and we certainly can. If you're not a Gravita client and you do want some help with that, do reach out to any one of us, and we can certainly help with that. We've got some questions which we'll come to in a moment, but look, we sort of sped through a lot of the planning ideas that you could be thinking about pre-6th of April. There are things we haven't said. You could think about equalising your income between spouses, so you're utilising a spouse's basic rate band and personal allowance. It was mentioned as part of the capital gains tax as well about EIS and SEIS and the favourable capital gains tax treatment there. But think of the income tax treatment as well. You can get a tax reducer if you subscribe for those shares. IHT mitigation and tax planning there has been subject of other webinars in the Gravita series. So we haven't mentioned that there, but it's important to keep that at the forefront of your mind. If you qualify for business property relief, remember that those restrictions are upon us or soon to be. Think about trusts, family investment companies. Trusts, on the face of it, tend to sort of seem intimidating. They're not, and they're not tax inefficient, as some people would have you believe. The way they're taxed is different. You might pay a tax up front, but that's not lost tax. That's credited to the beneficiaries later. So not tax inefficient as some people would have you believe. So do think about any of that. And if we can help with any of that, do reach out to us. If you're a Gravita client, reach out to your usual Gravita contact. If not, reach out to any one of us, or either you're a usual Gravita client and want to reach out to one of us, do as well. And we'll be very happy to help. We've got looking at some questions. Charlene, there's a question on if I've made a charitable contribution, but I didn't claim gift aid at the time, is there anything I can do to correct that?
Yes, there is a remedy, although it's time restricted. So you can go back up to 4 tax years using a process called overpayment relief claim. There's a set format, which is set by HMRC. So it's normally done by letter. You have to include all the details that you've made within your existing return and the tax that you believe has been lost. And HMRC will go through a process of correcting that. So again, it's important to keep your records, and if you need any help, you can reach out to us. We've had a lot of successful overpayment relief claims processed with HMRC in recent years. Yeah, look, HMRC are very keen on sticking to or going beyond assessment time limits and trying to collect tax where they can. So it's important to note that there is that taxpayer relief, the overpayment relief that you mentioned, Charlene, and use it. You know, if you get past that 4 years, there's no way of extending it. It's a limited time. So you know, in 6 weeks, we're at the end of the tax year. If you need to make a claim, another year is going to fall off if that's the 4th year. So if you think that you can claim tax relief on any of those contributions, do get in touch if you want some help about how you can make an overpayment relief claim. There's another question, Lekhrani, it's about pensions. And it says, you mentioned annual allowances. If I haven't used all of my annual allowance in 1 year, is there anything I can do about that?
Absolutely. So as mentioned before, if you haven't used all your annual allowance in 1 year, you can carry those forward. So you have the current year allowance that you could use and the last 3 years that you have. So by 5th of April 26, you could use your unused allowance for 22-23 tax year. And after 5th of April 26, the 22-23 will drop out. So if you have got enough there, you can use it. So do make sure that you have this calculation ready and use it before the end of the tax year. Yeah. Okay. So it's like a relief that you can carry forward and utilise it if you haven't used it all. Absolutely. And once you're past that 3 years, it's lost. It's lost. Yeah, so your 22-23 will be lost, and then another year will be added. But make sure you utilise it. It is there for you to use, and it's still a bit generous at the moment. Absolutely, yeah. I mean, that went up, didn't it, from 40,000? It did indeed, from 40,000 to 60,000, and we hopefully that keeps increasing, but I doubt it. But with HMRC are going down. And they sort of scrapped the lifetime allowance. Do you remember we used to have the lifetime allowance as well? Has gone now, but it's still relevant for earlier years. And we're dealing with many cases where HMRC are seeking a lifetime allowance charge on clients' pension pots where they've had fixed protection and they've erroneously made a small contribution that's then made them lose that fixed protection, and HMRC are going after a lifetime allowance charge. Regarding pensions, if that's you and you're in that position, let us know. And we've got cases going on at the moment where we're arguing with HMRC Pensions Compliance Unit about that sort of lifetime allowance charges that they're seeking to raise. So very complicated area, pensions. But generally, I think the message is, Lekhrani, it's still quite, from a tax perspective, still a good way of saving for your future in a incredibly tax efficient manner. I would say it is still a very good tax efficient tool. Do you still remember the days where you could carry pension contributions backwards? Yeah, I think there's a slide up at the moment that portrays how long I've been doing this. So, yes, I certainly remember that. So yeah, you could carry them backwards. Yeah, and we can't do that anymore. So just watch out for these generous reliefs that we still have for pension contributions and do make most of those whilst they are still there for us.
Yeah, no, absolutely. More questions. There's a question from Paul, and it's saying, if I sold my main home and moved into a second home, then 5 years later sold the second home to move into the new primary, does the 60-day rule still apply? So what's going on there? So you've sold your main home, you've moved into a second home, and then 5 years later you sell the second home to move into your new primary residence. They're all primary residences, so you wouldn't be in the 60-day.
Well, you would hope that principal private residence relief does apply, but it's important just to be careful here, because HMRC will look at someone who is buying homes and selling them frequently. They may choose to target that individual if they consider them to be flipping houses rather than legitimately living in them. So you want to make sure it's established as your primary residence and that you are legitimately living there before you make the claim for principal private residence relief.
Yeah, and if he makes the claim, is not within the 60-day reporting, is that right?
Correct. So if you're selling your main home, then generally this will be CGT free.
Yeah. So in those circumstances, Paul, I don't think you need to worry about the 60 days, but it's a valid point, a really good point that Charlene makes about if you do that regularly and consistently, and there's a pattern to it, HMRC will say, or could argue, that you're flipping properties and you're trading in properties. If that's the case, any gain won't be exempt under capital gains tax principle private residence exemption. It could be chargeable to income tax, but you'd have to do that frequently and regularly and establish a pattern. But do keep that in mind if that's your plan. Henry says, will you be sending out the presentation slides? Yes, we certainly will. I understand there was an issue at the beginning where some of the slides weren't shown, but yes, Henry, you'll certainly be receiving the presentation slides. And when you get them, if there's any questions that you've got for us, do let us know. And we'll be happy to help. When is the deadline to claim work from home relief? Okay, well, that wasn't part of this webinar. I don't know off the top of my head. Do you?
Not really, no.
No.
But the work from home relief, HMRC is trying to cut down on this at the moment, because obviously during COVID, they were quite generous by giving that. With work from home, what we have to be careful with is if it is your own choice to work from home, rather than you are meant to be working from. If it's your own choice, HMRC might be very reluctant to give you that relief. However, if you're forced to work from home, for example, your employer doesn't have any offices anymore, then you do have a good case to claim the work from home relief. But again, it varies from case to case. So we are happy to take your questions further. So if you want to contact us after the webinar, we will be very happy to look into it and understand your situation as well, because like I said, it does depend on where you are, what you're doing as well.
Yeah, no, absolutely. Do reach out to Lekhrani on that, or any of us on anything that we've discussed. Part of what we do here at Gravita as well, we're specialists in tax investigations as well. So very often we see where it goes wrong, where someone's gone into tax planning. And when you go into tax planning, whatever tax planning it is, you do need to be very careful and take one step at a time to make sure that you're doing it correctly. Where it goes wrong, and HMRC challenge you, we have a tax investigations specialist department, which I lead, and we can help you on that. But dealing with that, you see the wrong end of tax planning that's gone wrong. So it's all well and good putting tax planning in place, and absolutely you should, because as we've discussed, once tax reliefs are gone, they've gone. It's use it or lose it very much. And where it goes wrong, you've only got that 4-year window that Charlene was mentioning earlier for overpayment relief claims. So if it goes wrong, and it does go wrong, trust me on that. If you passed 6 years and it's actually gone wrong, where you could have saved tax, there's no way of reaching that anymore. So, and if it goes wrong, HMRC's limits to go back off extended way beyond that. 4 years is a standard. They can go back 6 years if you were careless, and they can go back 20 years if you didn't notify them or you did it deliberately. So hugely biased extension for HMRC against the taxpayer. 4 years for the taxpayer, possibly 20 years for HMRC. There's another question from Jayesh. Are they really going to look at £312 relief? So that's the work from home relief again. So yeah, again, it's not something we discussed on this webinar, Jayesh, but Lekhrani has mentioned it. Do reach out to Lekhrani, and she'll be very happy to help you on that one, Jayesh. tax planning, as ever, is important. HMRC are tasked with raising more and more taxes. You saw that there was a surplus in January where the self-assessment taxes went in, so there was a surplus over expenditure. So the Treasury are very excited about getting more tax in. Once they've had that feeling, they don't want to get rid of it. So do look at your taxes. If you really want to help, or there's something we haven't discussed on here, do let us know, and we're happy to help. Gravita is a full service accountancy firm, so we can help you with anything accounting or tax needs, or audit as well. So let us know, reach out to any of us or your usual contact at Gravita. There aren't any more questions at the moment that are coming in, but if you think of something, do let us know after the webinar, and we'll be happy to help. So, thank you very much, Lekhrani. Thank you, Charlene. It's been incredibly helpful. And thank you, everyone.
Thank you.
Take care.
Thank you. Bye-bye.